GFC era, in my view at least, are secular bull waves. Historically, they last about 18 years. They produce a CAGR, a compound annual growth rate, of about 18% compared to the 11% average, that's nominal. And so by just that very simple metric and extrapolating, which is always a dangerous game, of course, back in '09, the S&P was 50% or 47% below that long-term regression trend line. If we get to 100% above in that 18-year time span, which is what the last few secular bulls have done, we would get to 8,000 in 5 years, 2027.
Okay, can you see the 3 rate hikes in 2022 that the market is pricing in happening, and the S&P still reaching 8,000 on that trajectory that you're talking about?
Well, we have to distinguish between secular trends and the cycle, right? So secular bull markets have many individual business cycles in them, including tightening, including bear markets, recessions, the whole thing. So I don't want to compare what's happening over the next 6 or 12 months to what a secular view is over the next 5 years.
Okay, but Jurriaan, just to then specify then, how high could rates go and maintain this trend that you're seeing?
So implied in this scenario is that the Fed is in do no harm mode, which I think generally is where the Fed has been in recent years, and that the Fed will listen as it did in 2018 and before in 2015. It will obviously look at the real economy, what's happening to employment and inflation, which of course generally are lagging indicators, but it will also look at what's happening in the financial economy as measured by, for instance, the Bloomberg Financial Conditions Index or the Goldman Sachs Financial Conditions Index, and by what's happening with spreads, rates, stocks, currencies. And my sense is, and I think maybe the long end of the bond market is sensing this as well, is that the Fed will only go as far as the market can handle. And in that respect, the markets will win, for the lack of a better word.
Well, Bank of America is pretty bearish on the year ahead, and they say we're in for a rate shock in 2022 after the inflation shock of this year and the growth shock of 2020. Do you see an actual shock, or will the Fed only act in a way that the market can handle?
I think the Fed will only act in a way that the market can handle. Now, obviously, inflation could become a more political issue. One could even question whether the nomination of the chair of the Fed chair, the renomination, if there was a political undertone in terms of whether inflation is going to be a political hot potato or not. But my guess is that at some point the base effects will come in. Maybe the CPI goes from 6 to 3, and maybe it goes up after that and will become more structural. But my sense is that the Fed will have some time here as it tapers to allow kind of some of these excesses to come down, and then it will just be on a slow and steady rate track like it was in 16, 17, 18, and then it will just watch financial conditions. It will try to get an estimate of what happens to R-star. But at this point, you look at the Fed funds curve, you assume 3% inflation. Even by 2026, the Fed is not yet back to even neutral, let alone tight. So the bond market would need to reprice itself pretty significantly to get to a super hawkish outcome.
Well, you mentioned there that the Fed's going to have time during the taper, but you now have Fed officials Raphael Bostic joining them here on Bloomberg Television last night saying we may need to do that more quickly. If they're accelerating the timeline, could that not get them into some kind of policy mistake?
Well, that is a tricky question, of course, because normally the Fed will taper, then it will just kind of be done tapering and maybe take a 6-month cooling off period before it starts raising rates. And then as it starts raising rates, maybe it then starts to shrink the balance sheet. So maybe that cooling off period won't happen this time, and it will go right from taper to raising rates. And again, the Fed funds curve is pricing that in, right? So the market and the Fed are in agreement for 2022 and 2023 as to how far rates can go up, and they should go up. I mean, the output gap is gone, the employment gap is gone, inflation's at 6%. There's no way that the Fed should be at 0 and buying 120 billion a month. So I think everyone is on board with that. but they need to tighten slowly enough or not too quickly enough to not get financial conditions to seize up. And so far they're not. They're very loose. Credit spreads are still very tight. So far so good, but it's going to be this dance that we do every cycle.
Jurrien Timmer, thank you so much. Greatly appreciate it. Really informative there with Fidelity Investments. Lisa, I got out the fancy Bloomberg Surveillance HP12C calculator.
That kind of
and
Tuesday.
you get out to SPX 8000 5 years out. SPX 8000 is 11% per year.
Yeah, and a lot of people say that that's doable. I want to go to something he said, though, that I found fascinating. The market will win when all is said and done, that the Fed will not disrupt the status quo. To me, that tells you why yields perhaps are where they are, why they are negative on a real basis to the degree they are, and why a lot of people think they're going to stay there.
And from the gentleman from Babson College. Lisa, here's a headline, which is the ramifications of Lira. 1 year paper in Lira just sold at 20.77%.
Yeah,
That's
it's
the real
insane.
world ramification.
The borrowing costs for that nation are absolutely skyrocketing.
Stay with us in Istanbul and stay with us worldwide across this nation. Kaylee Lyons in for John Farrell, Lisa Abramowitz, and Tom Keene. Today, as always, on radio, on television. Lisa, it's a beautiful New York City morning.
Yeah, it's a good one for shaving.